Welcome to the Deep Dive, the show built to get you well informed quickly and thoroughly. Today, we are setting aside the spreadsheets, all the quarterly earnings reports.
Yeah.
We are diving deep into the intersection of finance and really human behavior. And we're drawing extensively from the works and philosophy of Morgan Housel, specifically his core ideas in the psychology of money.
That's right. And our source material here is just incredibly rich.
Mm.
I mean, it completely ignores the day-to-day noise of the market,
Right, the chatter.
all of it. And instead, it focuses entirely on these enduring, non-mathematical truths of building sustainable wealth and, maybe more importantly, sustainable happiness.
Exactly. So the mission for you, the listener, today is to fundamentally redefine what wealth even means. We're going to unpack why success with money is. Well, it's less about being some analytical genius or picking the next breakout stock,
Much less.
and much more about simple, achievable behavior, endurance, and recognizing what money can and, just as critically, what it fundamentally cannot buy for you.
And if we frame this whole conversation around one single concept, it's this. Longevity and endurance are the single greatest investment edges you can possibly possess.
That's the whole game.
It's the whole game. We're going to explore why becoming, as House puts it, filthy rich, isn't a function of getting the biggest return in one fantastic year. It's about sustaining average returns for the longest possible time.
Right.
And that shift, that one little shift, transforms the challenge of money from this cold mathematical equation into a really deep psychological puzzle.
Okay, so let's start right there at the root, because Housel begins with a core redefinition that I think most people just get wrong. We use the words rich and wealthy like they're the same thing.
We do, interchangeably. But he sees this crucial distinction between them.
And it's a huge distinction.
It's vital. I mean, it changes everything about how you think about saving. Rich is visible. It's what you see.
The stuff.
The stuff. It's the money that has been spent, the massive mortgage, the brand new luxury car, the ability to walk into a store and buy an expensive watch today. It's all signal, it's status, and it's immediate.
So rich is what you can afford to spend right now.
Precisely. Now, wealthy is the complete opposite. Wealth is hidden.
Ah,
It is the money that was not spent. It's the money in the savings account, in the investment portfolio. It's the money that could have bought the nicer car, but didn't. Wealth is the option value you've created for yourself by waiting.
that immediately hits on what he calls the spending paradox, doesn't it?
It does.
When the average person says, I want to be a millionaire, they almost never mean they want $1 million sitting untouched in an index fund.
Right.
They mean they want to be rich enough to spend $1 million on things that, signal their success to the world.
And that desire for signaling, that's the source of so much financial misery, Housel argues. The true goal has to be the latter, the unspent money, because unspent money buys you something so much more valuable than any object, independence and autonomy.
He brings in the great Charlie Munger here, who, despite being unbelievably successful, always hammered this point home.
Munger famously said, I never wanted to become rich. I just wanted to become independent. And that focus is everything. Housel breaks down savings not as a sacrifice, not as something you're giving up.
Right, not as deferred pleasure.
No, you're buying your own time. Every single dollar you save is a piece of your future that you now own. It's currency you can use later to dictate your own schedule, your own pace, your own life.
I think we all kind of get that instinctively, but how does Housel connect that financial control directly to something as fundamental as, say, happiness or even our physical health?
Okay, so this is where it gets really deep. He argues that autonomy is one of the biggest, most powerful puzzle pieces of human happiness. And on the flip side, a lack of control is just this massive anchor, this weight on your life, your health, your mental sanity. The sources detail all this research on the physiological consequences of low autonomy and high stress. And the connection is,
Yeah.
it's startling.
So we're not just talking about being a little unhappy with your job. We're talking about actual physical harm.
We are talking about literal heart health. There's research that shows that people in low-control jobs are way more likely to experience chronic stress that actually manifests as cardiovascular problems and heart disease.
How does that work? What's the mechanism?
It's hormonal. When you're in this persistent state of low autonomy, your body releases chronic levels of stress hormones, like cortisol.
Cortisol, the fight or flight hormone. But it's just constantly dripping into your system because you can't control your fate.
That's the perfect way to put it. A little bit of stress is fine. Your body's built for it. But this chronic low-grade cortisol exposure, which is exactly what a lack of control provides. It just batters your cardiovascular system for decades. Your heart literally pounds harder, your blood pressure stays elevated.
So financial independence isn't just a comfort, it's a physical shield. A shield against one of the biggest killers in the world, simply because it removes that constant low-grade stress of having no control. That's a powerful reason to save.
It's the ultimate incentive.
Mhm.
And Housel illustrates this so well with the case study of his own father, the frugal doctor.
The ER doctor, right.
Yeah.
So high income, but a brutally demanding job.
Absolutely brutal. His father was an ER doctor for 20 incredibly stressful years.
Hmm.
Night shifts, medical emergencies, the emotional toll of watching people die in his arms.
Yeah.
It was exhausting. And when he hit age 60, he just realized he was burnt out. He needed to stop.
And the key was that he could stop immediately.
Right. Why? Because he hadn't inflated his lifestyle to match his salary.
He resisted the urge.
Completely. When Housel was growing up, they lived way, way below their means. The frugality they needed when they were younger and poorer, it just stuck with them, even after his dad's income shot through the roof. Their savings rate was remarkably high.
And Housel, as a kid, he didn't get it. He wondered why they didn't have the bigger house or the nicer cars his friends' parents had.
Of course not. And that's the psychological friction, isn't it? As soon as you see your paycheck go up, there's this powerful urge driven by ego, by social comparison, to match your spending to that new income. The doctor just actively resisted that.
And the payoff was huge.
Profound. His ability to just retire at 60 and reclaim 100% control over his time made him so much happier than any luxury purchase ever would have. Meanwhile, some of his colleagues, earning the same high salary, just as burnt out.
They couldn't stop.
They couldn't retire because they had the bigger house, the boat, the fancy school tuitions. They had swapped their future autonomy for current visibility.
That forced dependence, even with a high income, leads directly to this concept of reactance. That's the psychological term Housel brings up.
Yeah, reactance is what psychologists call that negative emotional reaction you have when you feel like your freedom is being threatened or controlled, even if it's something you love doing.
So if you love building rockets, but your job forces you to build rockets 80 hours a week on someone else's schedule, that joy just starts to fade.
It starts to feel the same as doing something you hate. And this is the core of the CEO trap. You might have a CEO making $30, $40, $50 million a year, but every single second of their calendar is demanded by someone else. Board members, investors, travel schedules.
They're rich, but they're not wealthy in time.
Exactly. Immense wealth, but zero autonomy. And the financial antidote to that, the example he uses is Warren Buffett, who's worth, what, over $100 billion?
How does he sidestep it?
Buffett's example is so crucial because it shows maximizing wealth doesn't have to mean maximizing stress. Buffett maintains total control over his day. He reads, he thinks, he plays bridge.
He's not in back-to-back meetings.
No, he runs his company with incredible delegation and insists on having the time and space he needs for deep thought. He has deliberately engineered his entire life to avoid reactance.
And that control, it allows him to just say no to things that don't fit his long-term focus.
Right. Housel notes that the ability to just decline a business deal simply because saying no pays better than saying yes, that is a definition of wealth in itself. It means you don't need the money, and so the money can't control you.
So the immediate practical takeaway from this first section is, if you're saving, don't think of it as deferred pleasure.
No.
Think of it as buying literal physical resilience and future control over your most valuable non-renewable resource, your time.
That's it. Wealth isn't the Ferrari. Wealth is the ability to take the day off when you want, without asking anyone and without financial consequence.
Okay, so that focus on longevity, on endurance, that brings us right to the mechanics of how money actually grows over decades. The concept is compounding, and Housel argues it's just fundamentally unintuitive to the human brain.
Our brains are just not wired for it. Not for exponential thinking. We're great at linear calculations. If I tell you to add 8 plus 8 plus 8, you do it instantly, 32.
Easy.
But if I ask you to calculate returns multiplying on themselves year after year after year, our intuition just dramatically underestimates the result. It feels like magic.
It's not magic, it's just math.
It's just math. But it's why he calls it a leap of faith or even a mathematical religion. It's something you have to believe in, especially in the early years when the market is volatile and the numbers look tiny.
The famous chessboard analogy comes to mind.
The perfect analogy. The king promises the inventor a single grain of rice on the first square, 2 on the second, 4 on the third, doubling every day.
For the first half of the board, the numbers are big, but they're manageable. The inventor's still poor.
Exactly. But once you hit the second half of that board, the returns become, well, they become astronomical.
Yeah.
More rice than exists in the entire world.
That's the tyranny of the exponent. It's nothing, nothing, nothing. And then suddenly, everything happens all at once.
And that is the core insight. If you look at the compounding formula, all the heavy lifting doesn't come from the base return, the 8 or 10% you earn this year.
Right.
It comes from the exponent, which is time. It returns to the power of the number of years you can just hang on.
So the logic follows. Your long-term success isn't about getting the highest returns you can snatch in some market boom.
No.
It's about the returns, even if they're just average, that you can sustain for the longest possible time. Endurance is the key performance indicator.
It shifts the entire focus away from trying to be a genius and toward simply ensuring your own survival in the game.
Yeah.
And we have 2 case studies in the source material that illustrate this time factor perfectly, and they're from opposite ends of the economic spectrum.
Let's start with a big one, Warren Buffett. We always focus on his stock picks, but Housel zeroes in on his longevity.
Buffett is the ultimate example of time winning. People analyze his letters, his philosophy, which is all great, but the real secret is that he has been a good investor for about 80 years. He started at age 11.
80 years.
Now, here is the staggering fact. 99% of Buffett's net worth was accumulated after his 60th birthday.
Wow. That is a brutal statistic for anyone in their 20s or 30s who's feeling impatient. 99% after 60.
Think about that. He was worth about $3 billion at age 60, which by any measure is fantastically rich.
Of course.
But because he just kept compounding, because he endured, he is now worth over $100 billion. If he had cashed out or retired or just gotten bored at 50 or 60, he'd be a footnote. Nobody would know his name today. His greatness is purely a function of his time horizon.
And the numbers just get so ridiculously big at the end because of that exponent. A simple 10% gain on $3 billion is $300 million. A 10% gain on $100 billion is $10 billion.
Right.
He makes more than 3 times what he was worth at 60 just by holding on for one more year now.
The game changes completely. That is the definition of filthy rich, is Lassel's language. It's the wealth that's been allowed to endure and compound long after the initial skill was required.
Okay, so if Buffett shows us what happens when genius meets longevity, the second case study removes the genius entirely. Ronald Read, the janitor millionaire.
Ronald Read is maybe the most humbling story in all of finance. He mopped floors at a gas station, he worked as a janitor in rural Vermont, and when he died in 2014, at age 92, he had an $8 million fortune.
$8 million. From someone working a job that was, minimum wage adjacent for decades. How did he do it without any special knowledge?
His method was painfully simple. He took whatever little money he could save, $100 here, $200 there, put it into blue chip stocks, and then he left it alone for 70 years.
70 years.
And Housel emphasizes this point. Picking the next Amazon is extremely hard. It requires huge skill, luck, everything. But endurance, patience, avoiding panic selling, that is largely in your control. Read had the psychological strength to just wait.
And that's the part that needs to be stressed, the psychological cost of that endurance. I mean, Read lived through the Great Depression, World War II, the 70s oil crisis, Black Monday, the dot-com bust, 2000. If he had panicked and sold during any of those crises, his wealth would have just disappeared.
He had to resist that powerful emotional urge to follow the herd and run for the exits. That resilience, that willingness to just look boring for 7 decades, that was his genius. He wasn't a role model for a luxury lifestyle. He lived very frugally. But he's the ultimate role model for the quiet, boring, unstoppable process of compounding.
So if the key is maximizing that endurance, what does Housel recommend as the actual strategy? He has this painfully simple 3-part plan focused on index funds and dollar cost averaging.
Yeah, this whole strategy is built for survival, not for maximizing your quarterly returns. The 3 parts are cash, a house, and index funds.
Let's talk about the index funds.
So an index fund is a single investment that owns a tiny slice of hundreds or even thousands of different stocks. It usually tracks a major index like the S&P 500.
The genius of that, then, is that it ensures you capture those few big winners, the long tail ones we'll get to later, while minimizing the damage from the thousands of losers.
Exactly. You are literally capturing the growth of capitalism itself. You don't have to worry about picking the next Apple or Tesla. You own them all. This dramatically increases your odds of surviving for 70 years. And then you pair that with dollar cost averaging or DCA.
DCA, which just means buying the same dollar amount every month no matter what, whether the market is booming or it's crashing.
And this is such a crucial emotional dampener. It removes that human tendency to try to time the market, which almost always leads to buying high and selling low.
The classic mistake.
By committing to DCA, you maximize your endurance because you are systematically taking your emotions out of the equation. When the market falls 20%, you should be excited because your monthly investment is buying more shares. But emotionally, people panic. DCA stops that error.
So the investor's goal is to just maximize their time in the market. Housel says if you can earn average returns for an above-average period of time, you will be in the top few percent of investors in the world.
The wisdom is so simple, but the execution is so hard because it requires you to actively ignore all the noise and volatility. That's why that old joke Housel uses is so true. The key to investing is to lose the password to your investment account.
Right.
That inability to check it every day prevents you from selling during the inevitable chaos, which is precisely the moment when most people bail out and destroy their 70-year advantage.
Okay, so the market will be volatile, that much is a given, but that focus on endurance means you have to survive not just the predictable ups and downs, but the sudden, completely unforeseen shocks. And that leads us to Housel's philosophy on risk. The biggest risks are always the ones we cannot possibly see coming.
This is one of the most, I think, intellectually honest and sobering points he makes. If you just look back at the last couple of generations, the biggest risks to the U.S. economy and society, Pearl Harbor, 9/11, the 2008 financial crisis, COVID-19, they all share a crucial common denominator.
They were unknown unknowns.
Exactly. The day before they happened, they were not the headline news. They weren't being discussed by the leading economic forecasters. I mean, 2008, sure, everyone knew housing was a little frothy.
Right, there were whispers.
But the mechanism of the failure, the collapse of AIG, Lehman Brothers going under, the credit markets just freezing solid, that was a completely unprecedented systemic surprise.
It wasn't the bubble, it was the domino effect that nobody had modeled. And Housel guarantees that the biggest risk over the next decade is something we literally cannot even fathom today.
Which is why he argues that trying to forecast the next recession or the next crisis is a fundamentally impossible and frankly foolish game. Because if it was foreseeable, it would already be priced in and it wouldn't cause a massive shock.
Right.
The ability to predict the future requires us to piece together this map of the world where chaos theory just reigns supreme.
And this skepticism of prediction, it's rooted in an incredibly personal and tragic story Housel shares about a ski trip. It brings that chaos theory of life into this really sharp, painful focus.
Yeah, it's a story that just grounds his entire philosophy. When he was 17, he grew up ski racing, and with two of his friends, they decided to take an out-of-bounds run. They triggered a small, manageable avalanche on the first run.
Okay.
His friends wanted to go back for a second run. Housel, for what he called a completely brainless decision, no pros and cons, no deep thought, just a gut feeling, he said no. He went to drive his truck around to pick them up at the bottom.
And his friends died in a massive avalanche on that second run.
That's right. That one trivial, thoughtless decision completely bifurcated his life. He lived and they died. And his realization was that the world hangs by these impossibly thin threads. Tiny, seemingly nothing decisions can utterly change the entire course of your life.
We can't piece together chaos theory, which means we can't predict the next recession or our career path or even how long we'll live. That randomness is why risk is so hard to define.
Which leads to the definition Housel quotes from Carl Richards. Risk is what's left over when you think you've thought of everything.
I love that. Risk is a thing you failed to model.
Exactly.
So given that we can't predict, we have to focus on a strategy of preparedness. And this is where he pulls in wisdom from Nassim Taleb.
Taleb's advice is crystal clear. Invest in preparedness, not in prediction. If you just accept that you cannot predict the next surprise, the only logical financial strategy is to build a robust fortress that can endure any surprise. It's about being anti-fragile.
Okay, but how does that preparedness translate into an actual investment strategy? Because for a lot of listeners, this just sounds like holding a massive amount of cash, which goes against the classic advice of always being fully invested.
This is the exact tension Housel addresses. He argues for the necessity of a significant cash buffer money that is not earning maximum returns. The amount of cash you hold, he says, should feel like it's too much.
It should make you wince a little bit.
Exactly. Because of the opportunity cost or the drag from inflation.
Why must it feel uncomfortable? Why the wince?
Because if the amount of cash you hold feels comfortable, it means you only have enough to cover the risks you can envision.
like losing your job for 3 months or needing a new roof.
Right. The predictable stuff. If that's all you have, you are completely unprepared for the true surprises. You will miss every single black swan event. The wince factor means you are holding cash for risks you can't even name.
So when people ask Housel what he's saving that cash for, his answer is incredibly philosophical.
I don't know.
I don't know. He's saving for the life risks he cannot predict. That's the key. Cash is financial ammunition. It's optionality. It lets you take advantage of market downturns when everyone else is forced to sell, or personal calamities when everyone else is forced to borrow.
This need for preparedness, it also forces us to adopt two opposing mindsets at the same time. The optimism you need to gain wealth, and the conservatism you need to keep it. That sounds like a constant psychological war with yourself.
It is. Gaining money requires optimism, boldness, taking risks, swinging for the fences, and believing the future will be better than the past. But keeping money requires survival skills. Conservatism, humility, acknowledging that you don't know what's coming, even a little bit of paranoia. And you need both.
You need to run both operating systems in parallel for a lifetime. If you only have optimism, you'll gain money fast, and you'll lose it just as fast in the first crisis you didn't see coming.
So we've talked about the mechanics of growth and preparing for risk. Now we have to address what might be the ultimate psychological hurdle, just defining enough. Housel argues the hardest financial skill of all is getting the goalposts to stop moving.
This is the primary reason why just getting a high income or a high net worth doesn't automatically make you happy. And we have the data to prove it.
Right.
Since the 1950s, the average American household income has roughly doubled, even after you adjust for inflation. But happiness surveys, all these statistics, they show that society is arguably less happy today than it was 70 years ago.
And that gap, the source material suggests, is driven entirely by expectations and social comparison. We adjust instantly to the new baseline, the bigger house, the fancier lifestyle, and then we immediately look sideways.
To the neighbor, the colleague, the person on social media,
Yeah.
and we move our goalpost further down the field. This is the hedonic treadmill in action. Housel stresses that the first rule of happiness is actually quite simple. Low expectations.
Happiness is the gap.
Happiness accrues in the gap between your circumstances and your expectations. If you can manage your expectations downwards, you automatically increase your happiness regardless of what's happening outside.
It's empowering because managing your expectations is so much more within your control than trying to magically increase your income. You control the internal dial, not the external world.
And for a really radical demonstration of this, Housel uses the powerful example of Stephen Hawking.
The physicist who lived for decades with severe motor neuron disease.
Right. Hawking was asked in an interview about his secret to happiness. And he said his expectations were just dramatically reduced to zero when he was diagnosed at age 21 and told he only had a couple of years to live.
Wow.
And he stated, very frankly, everything else since then has been a bonus.
That is profound. I mean, if someone facing those kinds of enormous challenges can find massive happiness by just operating from a baseline of zero, it proves that material success is totally secondary to psychological management.
Your relationship with your own desires dictates your contentment way more than your bank balance does. Housel notes the cruel reverse is also true. A pro athlete making $20 million a year who needs $30 million to feel adequate is psychologically desperately broke.
Meanwhile, Ronald Reed, the janitor, who only needed $40,000 a year to be content while he was sitting on $8 million.
He was fantastically wealthy in spirit and in security.
So if the goalpost is always moving, what's the prime mover? What's pushing it? Housel points directly at the ego, the need to impress other people. He calls it the valet paradox, or the vanity tax.
This insight hit Housel when he was working as a valet at a high-end hotel. Day after day, he saw people pull up in Ferraris, Rolls-Royces, all of it. And he noticed something consistent. He never once looked at the driver and thought, wow, that person is cool, or that person must be successful.
So what did he think?
He only imagined himself as the driver. He thought, if I were driving that car, people would think I was cool. And that was the realization. Nobody cares about your car or your house as much as you do, because to the extent they're even looking, they're just using your success as a backdrop for their own internal fantasy. They're imagining themselves in your shoes.
That's the valet paradox. The expensive thing you bought to project status to others only inspires them to dream about themselves, not about you. It completely backfires.
And once you recognize that's the game, Housel says, Your desire to show off just plummets. That desire is the vanity tax. It crushes your savings rate. It traps you in high expenses. It reduces your autonomy. The most valuable financial skill you can cultivate is not needing to impress other people,
He says that's $1 billion asset on your balance sheet.
because you just stop paying the premium for ego.
And this philosophy of low realistic expectations, he even extends it into one of the most critical parts of life, relationships and marriage.
Yeah, he shares this marriage theory from his friend Brent. And Brent argued that marriage only really works if both partners want to serve the other partner and expect nothing in return.
Zero expectations.
Zero. When you both enter the relationship with zero expectations for personal validation or immediate returns, you're just pleasantly surprised every single day by the small acts of kindness you receive.
Because anything they do for you feels like a bonus, not a requirement you're owed.
Exactly. Housel suggests that what often breaks love, what causes so much misery, is neediness. And neediness is just massively high expectations in a relationship. If you expect your partner to validate you, to manage your emotions, to provide a certain lifestyle, you are setting the stage for profound, chronic disappointment.
So whether it's money, career, or love, happiness is found by managing that gap between what you have and what you demand. And it's usually easiest to manage the demanding side of that equation. We focused a lot on longevity and being conservative, but obviously, to get the wealth that requires endurance, you have to take risks, you have to seek growth. This leads us to Housel's philosophy on failure and the long tail, the idea that only a few things that happen explain almost everything that matters.
This long tail phenomena, or the power law, it's absolutely everywhere in finance and innovation. There's a couple of things that happen explain 90%, maybe even 99% of all the returns.
What are the concrete examples he uses?
In venture capital, it's well documented. A typical VC fund makes, say, 10 investments. 9 will fail completely or just return the initial cash. But that one single winner, the tail, will drive 100% or more of the entire fund's total returns.
And it's the same in the public stock market.
The same. The vast majority of stock market returns over the last few decades are driven by just a handful of huge companies: Apple, Microsoft, Amazon, Tesla.
And this is the ultimate mathematical justification for our endurance tool, the index fund.
Correct. The moment you understand that most companies fail and that 1% of investments drive 99% of the games, you realize you have to own a slice of everything. Indexing is simply accepting mass failure as the price you pay to capture the vital tail.
Trying to pick only the winners is a fool's errand. You're statistically guaranteed to miss the one or two that actually matter.
Which necessitates an entirely different psychological framework, a measured acceptance of, or even an embrace of, failure.
You have to institutionalize failure.
Right. Jeff Bezos, for example, he openly said that Amazon must be the best place in the world to fail. They have swung 10 times, knowing 9 will be miserable failures. Think of the Fire Phone, Amazon Auction, all these other projects.
Right.
But the one winner, like Amazon Web Services, AWS, that revolutionary cloud computing service, it was so ridiculously profitable that it paid for the entire graveyard of mistakes and then some.
So if you're not failing, you're not taking enough risk. That's the key for innovation.
The Netflix CEO famously reacted badly when a report showed that every new movie they released was a hit. His reaction was, if every movie is a hit, we are not taking enough creative risk. We should have a measurable mistake rate.
If your results are 100% successful, it means you're playing too small a game.
Exactly. Success requires comfort with frequent losses. But success itself, it creates its own inertia. Housel calls it the gravity of success. Competitive advantages are often short-lived because being successful plants the seeds of your own decline.
The gravity is psychological and it's structural.
Totally. A company that was successful because its founder was a genius product person is now a massive enterprise. That successful founder is no longer tinkering with the product. Their time is now consumed by HR, legal compliance, global politics, quarterly earnings calls.
All the bureaucracy. They're pulled away from the core function that made them successful in the first place. They're managing complexity now instead of pursuing innovation.
And the successful startup slows down. It becomes vulnerable to the next hungry upstart that has nothing to lose. And this applies personally, too. The insecurity and hunger that drove your early career often just evaporates once you're financially secure. And you need this massive, sometimes painful, mental recalibration to keep running and avoid getting complacent.
And finally, let's explore this idea that stress and pain and discomfort, they aren't just costs. They are the moments when the magic happens. That positive growth comes bundled with negative experience.
Housel argues that discomfort and shock are often the prerequisites for breakthrough progress, both societally and personally. On a societal level, nothing has been more technologically progressive in a short period of time than World War II.
Necessity is the mother of invention.
Absolutely. The need to solve this massive global existential problem forced unprecedented innovation. It led to the rapid development of atomic energy, jet propulsion, computing, radar, penicillin. The immense pressure and discomfort of global conflict forced progress that might have taken 50 years otherwise.
And this holds true on a personal level. Being laid off, a medical emergency, personal tragedy. It's often the hardest thing in the moment, but in hindsight, it can be the catalyst for your greatest personal growth.
Housel uses the example of Stephen Colbert, who, suffered this profound personal loss when he was young. And he said he was grateful for his loss.
That's a hard thing to say.
It is. Not because he wanted the tragedy to happen, but because it allowed him to understand other people's emotions, to get closer to people, and to gain this essential sense of humanity that informs his entire career.
That's a powerful reframing. It's impossible to feel gratitude in the moment of suffering, but later you can realize that the costs paid in pain and uncertainty were actually necessary for the resilience and the growth that followed.
That's the takeaway. Most things worth pursuing: a growing portfolio, a meaningful career, a successful relationship, they charge their fee in the form of stress, uncertainty, and hassle. You just have to be willing to pay that non-monetary cost to earn the reward. #outro.
Wow. This has been such a necessary and a deeply human dive into money management. We've managed to completely strip away the confusing jargon and focus on these internal psychological levers. So let's quickly summarize the 3 core pillars we've uncovered today.
Okay. First, the definition. Independence is the true metric of wealth. We have to redefine success away from what we spend, being rich, and toward our control over our time, being wealthy.
Autonomy.
Autonomy and the reduction of chronic stress that comes with it, that is the highest dividend money pays.
Second, the mechanic. Endurance is the greatest investing edge. Success is not determined by the best possible annual return, but by the returns you can sustain for the longest period of time.
Which demands simple strategies like indexing and DCA, the faith of compounding, and the humility to just avoid panic selling during all the volatility.
And third, the survival mechanism. Managing expectations and ego is the key to happiness. Happiness lives in that gap between your circumstances and your expectations.
And the most valuable financial skill you can cultivate is just not needing to impress other people, because that's what allows you to stop the goalpost from moving and finally define enough.
I think the most crucial thing Housel emphasizes is that this discussion is not meant to be specific advice. We don't know your life, your time horizon, your circumstances.
Exactly. Investing is personal finance, not just finance. Our mission is simply to get you, the listener, thinking clearly about who you are, what your vulnerabilities are, and what money can and cannot actually do for you.
As we wrap up today, let's circle back to where high ambition meets psychological failure. It's a critical lesson Housel often highlights. We need to remember the story of Jesse Livermore, the famous 1920s stock operator. He was an absolute genius at gaining money.
A true phenomenon. Livermore became the equivalent of a billionaire, a massive fortune 4 separate times during his career. But he repeatedly lacked that second skill we talked about, the ability to keep money.
He was a master of optimism, but a total failure at conservatism. He just kept swinging bigger and bigger.
His success didn't increase his humility. It increased his confidence, far beyond his actual ability to predict chaos. He never knew when to stop. He never defined enough, and eventually he went broke for the final time and tragically took his own life.
His story is the ultimate cautionary tale of what happens when the goalpost moves forever.
It is.
So the ultimate challenge for you, the listener, is not just how to save or how to capture that long tail. The final critical task is psychological. How to define enough so that your success doesn't increase your confidence more than your ability, allowing you to survive the inevitable chaos and avoid the catastrophic trap of moving that goalpost until you run out of time or you run out of chances.
A profound thought to end on. If you can master that, the rest is just math. Thank you for joining us for this deep dive.
We'll catch you next time.